stupid.
You know what? I just wear it just for you now.
Yeah.
I wear it just for you now.
Your hat looks like a 6 and 6. That's what it looks
I
like.
just got a New Jersey too. I'm gonna start wearing it.
It's probably gonna end up looking like a 6 and 10. You know?
How's it going? Just like doing all the systems.
I'm just kidding. I like Rudin. I just like giving hard time.
I get it all down.
Yeah.
Yeah, when you do your writing everything down, we're just trying to get more organized and
How's it
going? I'm Jake.
Rami.
Rami, nice to meet you.
Pleasure.
Yeah. This is Matt.
Hey, Rami, I'm Matt. How you doing, Matt? Nice to meet you.
Rami.
Yeah, thanks for coming.
Rami?
Yeah, Rami.
With an M.
Rami.
Okay,
Yeah.
Rami. How's it going? I'm Jake.
Jake?
Nice to meet you. Nice to meet you.
Nice to meet you.
Well, there's more than 2 people, so we succeeded.
I know.
I was thinking it's just gonna be Steven and Hunter, right? Hunter? Yeah, and Steve? Okay. So is it with a V or a PH?
What's that?
Is it a V or a PH? It's Steven? V. Steve. It's just Steve? Okay, Steve.
It's incomplete.
It's incomplete? Steve.
With you? I don't know.
Bum, 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 bum. So Garrett, do we have like intro music that we can like run into? No? Dun-dun-dun, dun, dun-dun-dun.
I was gonna say you shouldn't.
Matt was gonna come with roller skates. We had a whole routine, but then there was no. We found out there was no music, and
You look good.
yeah.
Yeah, because I love dancing as much as I do standing in front of people.
Right, exactly. Maybe a little bit more, a little bit less.
It's nice for you guys. Yeah, of course. Yeah, of course. Nice to come back from the beach and, you know, out here in the Antelope Valley.
It's been too cultic.
I like giving you guys a hard time and exaggerating it a little, but I feel like every time I post, you really are used to it.
I know, yeah.
You're like, oh, we're on the beach
I'm
again.
working from the beach.
I'm sorry. Well, hold on, I got a client calling.
We're still working.
It's true.
Yeah, you're working. Still working. Yeah.
it's just our office view is much nicer.
Yeah, that's true. It's a lot nicer of an office view from the beach. No, man, I think that office bill's a little more expensive, though. Yeah.
Just a little bit.
So what do you guys normally do for these? Just a bunch of different people come in?
It's just our
Just
office
could be
member
anything?
wants to come in and enjoy and.
No, I mean for the speakers usually.
Oh,
Is
for
it just
speakers,
just
yeah,
could be anything?
It's we try to bring a bunch of different things.
Yeah.
For real estate training to wealth building to whatever.
Cool.
Yeah.
Cool.
Hi. Morning.
Hey Adam, what's up?
What's up, man? Good to see you.
Good. How's it going?
Good. It's been a long time.
You must be Carlos.
I am Carlos.
You see that?
I mean, how do you
I just know it, right?
You guys are good.
I'm Jake. That's actually why we're here. We're just gonna guess things about people.
All right.
No.
You guys are well prepared.
Yeah, right. I memorized everybody's. No.
What's that again?
No, I said I memorized everybody's name and face.
Don't remember our social life.
I wouldn't remember that. Yeah, right.
Oh, sorry. Yeah.
Good for you.
Willpower.
Me too.
I'm gonna
You
pass.
gotta fit in that dress on
I know, me
Saturday.
too.
I mean, that dress.
I know, me too. Ba-da-ba-ba. I'll put this. How's it going, sir?
It's good to see you.
How you been?
Good.
Good,
How
good.
about you?
So Rob finally got you.
Yeah.
I did.
Yeah.
I remember you like, he's trying to get me over.
Yeah, he
So when did you start?
Well, I started with Keller Williams probably 3.5 years ago.
Was it that long ago?
Yeah.
Oh my
dude,
gosh.
Time has flown
Yeah.
by.
I remember we saw you at Costco and you were like, oh, Rob's trying to get rid of
That's
that? That was 3 years ago?
Yeah, well, yeah, it was a little bit longer than 3.5. Yeah, man. So then I did well my first couple of years, and
Okay.
third year was
Just like selling and
yeah,
stuff?
I was
Okay.
just real estate.
Yeah.
And then that's when, what's up, man? Good to see you. Welcome. And then they approached me about, it's just kind of about
Sweet.
midway. Yeah, man.
That's
Yeah.
awesome, man.
Good
Yeah, I
to
know he
see
was saying, he's like, I'm working with Adam. I'm like, oh, I know Adam. Okay, yeah. Yeah. All right, did everybody sign in?
I did. Good. Yeah, my number. So far, so good.
You have my number? Did you guys sign in? Yeah? You sign in? Okay. You got it? Everybody got it? Yep, yep, yep. You guys got it all? You got the clipboard?
Oh, what's that?
Just a little sign in? Yeah.
We were told.
There you go. You got one.
I know. Okay, Les. I don't know.
That's one of the things we're going to talk about.
Yeah, us this is why we're here.
Yes, right.
From the office or
Yeah, how do you save money on taxes?
Yeah,
It's the big question.
you get that scary tax bill the year before. And
You go,
wanna pay
oh,
it again.
yeah, how do I stop that in the future?
Yes.
Yeah,
I had to pay $40,000 last year, and it made me cry.
and you didn't know it was coming?
No, I knew.
Oh, okay.
I think
Oh, good, okay.
I don't spend it.
Yeah, well, that's
I
good.
have a very lean business.
That's good. Yeah,
Yeah,
that's
I
good.
spoke to Adam about this a while ago. I'm like, Adam, can you help us?
Can you help us with this? Yeah. Yeah, so we'll have some people you can talk to, some referrals and stuff. You can. Yeah, yeah, yeah.
And then I mentioned
Here, I'll,
Thank you.
there you go. Okay.
What I did is I ended up making a list of
Oh, that you got the good one. That one looked good. I don't know what it is, but it looks good. Little mix there, yeah.
Like a week before, a couple days before, and a lot of them like, are you gonna go? Like, what? Like, you're not gonna tax them. They're not. So,
Oh,
but that was a small portion. It was like 4 of the 10 people I talked to, but that's still a lot. So I'm not sure. So,
yeah. All right, cool. Should we start? All right, y'all. Come on in, grab a seat. We're gonna start. Class. Settle down. This is fun. I gotta feel like I'm a teacher. All right. How's everybody doing today? Did you like the snow? Yeah? Did it mess up anybody's plans for Thanksgiving? No?
made the plans awesome.
Made the, right? Was anybody traveling? There was a couple people that were like, yeah, I was supposed to go visit my in-laws, and then it snowed, and I was so excited.
My in-laws were supposed to visit me and they couldn't make it.
They couldn't make it? Okay, yeah. You know, people who are like, oh, we're going to travel, and they're like, oh, good, I don't have to travel. This is great. It's going to stay in the snow.
Just kidding. This is on live Facebook.
Just, right? All right, well, my name's Jake. This is Matt. And Matt's going to talk real quick about why we're here.
Right. So again, we're Inspire Advisors here in Palmdale. We are a wealth management investment advisor firm located just up the street on Commerce Avenue. And we're here today because we deal with other real estate agents throughout the valley. And we've just kind of identified a few areas where we think we might be able to help you out. We realize a lot of you as independent contractors are self-employed people, so you don't have a set retirement plan that's offered to you by your company. You guys tend to generally pay way too much in taxes because of that. That's one of the consequences of that. And oftentimes we know real estate agents like to keep large sums of cash laying around, waiting for that next buying opportunity to pick up the next property. So a lot of times that may be a short window for you that you have to sit on that. Sometimes it could be a long window. And there's avenues that you can take that we'll present to you today that can put that money to work for you while you're waiting for that opportunity.
Yeah.
So
Does anybody do that? You guys have waiting for the next real estate crash? You got a bunch of cash laid up?
Right.
Or some cash laid up? That's like the common thing. Whenever I talk to real estate agents, they're like, I'm just waiting for the market crash. We were talking about that a little bit. It's like, it hasn't happened yet, you know, so I just have all this money making usually less than 1% in the bank. What do you do with it, right? So we'll talk about that a little bit today. So, cool. Okay, so so if you all have a little packet, so you can take a look at it. It's a little bit easier. These are some retirement plan options, and our goal is to kind of simplify this for you. What's the easiest way to save money on taxes? So I was talking to Jess? Oh, I was close. Okay, good. Right, taxes are a big thing for everybody, right? How do you save money on taxes? And so these are some ways you can kind of save. There's a lot of ways. I'll throw it out there real quick. So we don't do S corps. I heard it was passed around doing like incorporating and stuff like that. So before we get into this, one of the things I would highly recommend is talking to an estate planning attorney, someone who can set up like maybe an LLC or an S corp. That'll save you money on self-employment tax. So I won't go into the details of that, but if you want to learn more, you can talk to us afterwards on how that works. Is anybody incorporated? Yeah? Okay, good. A couple people. Okay. So if you're incorporated or if you're self-employed, you can do some of these retirement plans. And the main goal of these retirement plans, the reason you'll want to do them is save money on taxes, right? So the money you put into the plan, you don't have to pay in taxes that year. And so the main one we're going to highlight today is actually the top one, the SEP IRA. It is one of the easiest ones to set up. It's a one-page form that the IRS gives you, and then we set up the account. You put in the money, we invest it on your behalf. So it's super simple, super easy. You can save up to 25% of your compensation. So if you made $100,000 in commissions, you can save $25,000 in this vehicle and you not pay taxes on it. So does anybody have any self-employment plans set up right here? Anybody? IRAs, SEPs, simples, nothing? Okay. So this is really good for you, right? Save money on taxes and invest for your future. So you can set it up anytime. The reason we like that one too, you can set up anytime up to now or the due date of your return. So if you file an extension, that's October. If you don't, that's April of this year. So you can set one up all the way up to April, and you can put in up to 25% of your. So does anybody need more tax deductions this year? Mm-hmm. Right? Oh, yeah. Yep. Okay. So there's not a minimum. Yeah, no minimum. Yeah. So you can put up to 25%, and it's up to $56,000. So as long as $56,000 is less than 25%, you can do it.
When I always had that 6,000 maximum thing that people told me. Why? How do I do the SEP compared to that 6,000? I'm oblivious. So.
Yeah. So IRAs rate traditional IRAs you can only do 6,000. Mm-hmm. SEP IRAs for self-employed people you can do up to 25% or 56,000.
Do I have to be incorporated?
No. No. Just a self-employed person.
So now that's 25% from you as a
correct.
part of your corporation, but your corporation can always match that other percent, so you can.
So not yet, correct. So that's the next one. Yeah, you're talking about the simple. So the SEP IRA is just a flat 25%. Now, does anybody have employees besides Garrett? Employees? Do you guys have employees? Anybody? Or is it just solo shops? Everybody? Okay. So solo shops, 25%. If you have employees, the SEP IRA, you have to put in a certain amount, but you don't have employees, so we won't talk about that. The simple IRAs, it says simple, it's a little bit more complicated, so I won't go into more detail on that. And then a 401k you can set up, but that's a little more complicated. Again, we're going to recommend the SEP IRA. It's really quick, really easy to set up, and you can save money, 25% of your income.
So I know there's some people in this room that will have employees probably next year.
Right.
As
Okay.
their business is growing.
Yeah.
What does that look like if they have the SEP IRA started or whatever, and then now they've grown into a business? Because I know there's multiple people in this room that will have that.
Right.
What does that look like?
Yeah, good question. So if you have an employee and you have a SEP IRA, you have to put in a certain percentage, usually like 3% for that employee of whatever they make. So for you to be able to get your contribution. The simple might be better if you have employees, because the simple you can do here, you can do a non-elective or you can do a matching. So the matching you can do, so if they put in 3%, you can put in 3%, but if they don't, you don't have to. So you can kind of have some options there. So yeah, if you have an employee, you also might want to look at a 401k, because the 401k allows you to expand bigger. They can put in $19,000 on their own, so can you. Then the company can match up to 25% of what they make. So if you're wanting to put in double, you put in $19,000, put in 25% of what you make, and you can do both. So it's pretty cool. Good way you can save a bunch of money there.
19,000 is matching is what I thought it was.
No, 19 is what the employee contributions. Oh. Yep. So the employee non-elective, and then you can put in another 25% of all employee compensations from the employer. So you act as the employer and the employee in that. So, yep.
Okay, so this maybe jumping ahead. So say
you
provide that for the employee. They get that started up through you, right? Through your corporation. They
Correct.
leave you. Does that go with them? Can it, just like
it stays.
Company, you could roll it over?
Yes. Yeah, it stays. It's set up in their name. So if you guys set one up, it's set up in your name. So it stays individual. It's not even with the company.
Oh, that's cool.
Yeah. Cool. So, cool. Any more questions on this?
Quick question.
Yeah, go ahead.
Is there a difference on the rate of return from the SEP and the simple?
No, we'll talk about that because it depends on what you invest in. Right? You can invest in real estate, you can invest in stocks, you can invest in bonds. Whatever you want to invest in, you can do it in any one of these plans. So really cool. Yeah, really cool. Sweet. Okay, anybody else questions on the SEP, simple, or 401k? Good? Ways you save taxes? Okay, cool. Building a portfolio. So the way we look at it, answers your question, perfect question, lead in. How do you invest within the SEP IRA? So primarily we look at it with two main asset groups. These are the ones that are going to do well when the economy is doing well, right? So if the stock market, the economies are doing well, the economy of the U.S. is doing well. You're going to have large cap, mid cap, small cap companies we can invest in, growth and value stocks, U.S. and international, and then real estate, right? Real estate does well when the economy does well. It tanks when the economy tanks. We all see this, right? Real estate agents. So, and rental properties, commercial properties. So we call those growth asset classes. So those are the ones where the money moves. Money's moving into these asset classes when the economy's doing really well, okay? It's going to move out of these asset classes when the economy's not doing well. And here's where it's going to go. Government bonds, corporate bonds. You guys have heard of bonds? Has anybody invested in bonds before? No? Yes, a little bit? Okay. Bonds are more conservative of an asset class. They tend to go up. I'll show you a little slide on that. They tend to go up when the market's going down. Real assets like precious metals like gold and silver. Cash investments like money markets and CDs. So if you think about it this way, you think money never disappears, it just goes different places. Okay. So what happens is if you have money in stocks and you're fearful, let's say real estate, and you're fearful that the market's going to tank, what do? Sell. Most people, they sell. Okay. So then when you sell, where's the money go?
The government.
To the government, to taxes. It goes to like a cash position, right? Your bank or something. But then usually for there, if you think it's going to be a protracted down market and down economy, where do you put the money from there? Right? This is usually where the money goes. People might invest in gold. They might invest in CDs, or right? They might invest in silver. They might invest in corporate bonds, government bonds, treasuries, things like that. So if you think about it, you go, okay, so if people are selling from here and they're moving the money over here, when do you want to be in those asset classes? When the economy is doing good, it's going up. We want to be in these asset classes when it's going down, right? So in a nutshell, that's how we think about it. So if you might have real estate like rental properties and stuff, obviously, hopefully the income keeps coming in, but the prices of those properties are going to go down, right? So you want to try to, how can we diversify and protect against that? So let me show you how that works. Who remembers 2008? Right, okay. Did anybody have either your own house or a rental property or something in 2008? Yeah. What happened to the value in 2008? What were you buying again? That was in Germany, no. Right? So it went down by like 50% sometimes, right? Same thing with the stock market. So this is the S&P 500, so the top 500 stocks in the US. Google, Apple, right, all of those. It was down 37% from January to December of 2008. But during the year, from the peak you would have seen to the bottom, it was down 51%. So if you had 100,000 invested, it went down to 50. If you had 500,000, it went down to 250. Right? You had $1 million, it went down to 500,000. It's a lot of money, right, that people lost. This is why most people are afraid to invest in the stock market or the real estate market or stuff like that, because you have that potential for that much loss, right? But what a lot of people don't know is there was actually some asset classes that made money in 2008, and actually a lot of money in 2008. One of them was long-term government bonds, the blue one there. It was up 22% in 2008. 22% in 2008. So if you had 100,000, you actually had 122,000 at the end of the year. Okay, most people are like, wait, what? Why? Well, they were moving out of here, and where were they putting their money? There, right? So it's a buy-sell thing, right? They move their money out of certain asset classes. They might sit in it for cash for a little bit because they don't know what's going on. But the smart money, the institutional money, stuff like that, they're not going to sit too long because of inflation. So they're not going to sit their money in cash because they're losing money to inflation every year. So what they're going to do is they're going to take that money that they had in stocks, they're going to move it to cash for a short period of time, and then they're going to move it into some other asset class that still keeps up with inflation, which is why the key thing they do is they move it into long-term government bonds, okay? And a bond, just in a nutshell, is a loan. We understand loans. A bond is a loan. So if I loan Matt $100, I just kind of created a bond, and let's say it was over 1 year, and he was, going to pay 5% interest. That's a bond. That's all a bond is. So a corporate bond, you're just loaning your money to a corporation. Government bond, you're loaning your money to the government. And the reason that people and institutions and governments see this as the safest investment is because the U.S. government has, they always be spending their money, and they have a printing press. They can literally print money. So they're never going to go bankrupt when you have a printing press, right? So that's where the money goes there. It'll go into gold and silver and some other places, but that's the primary place it goes. So when you're investing in a SEP IRA or even in a non-qualified account that's just like an investment account, you want to think about where are we at in the economy and where should it be positioned in order to either be partaking in the growth or protecting from the downturn, depending on which side you want to be on, okay? So Matt's going to talk just a little bit about these. basically what we do is we take that idea and we've created 3 strategies. So he'll just kind of go over those real quick.
So once you've decided that you need to invest, the next thing that we do is to develop your time horizon. What are your financial goals, right? If you're sitting on cash and you want to buy another property, say in the next 2 years, you want to make sure that you protect that principal investment so that it's available for you when the time comes to buy that property. So one of the strategies that we employ is a protection-focused strategy which uses those protective classes as the basis for that investment portfolio, so that the likelihood of your investment still being there, that when the time comes to withdraw it and utilize it, chances are it's going to be there. Now, I know you asked about different returns and things like that. The protective strategy is probably going to get you a lower return. It's still going to be higher than it's sitting in a bank because it's not fully invested in the stock market. It's more heavily balanced in those protective classes.
And just to interject real quick, yep. So it's.
Oh, sorry, go ahead.
Yeah, no, go ahead. Go ahead.
What's the accessibility to that money when it's in there, as opposed to it sitting in just like a high interest savings account or something?
Right. A lot of it depends on the type of account that it's invested in. So if you did, if it's like a straight up investment account, like say a SEP IRA, then it's not accessible until essentially retirement.
Right.
But we also have non-qualified accounts, which are like after-tax accounts. So if you've already paid taxes on the money and it's just sitting in an account, you want to invest it, put it to work for you. We have those after-tax. It's like a standard brokerage account that it takes just a couple of days to get it.
Yeah, and the reason for that is because the IRS. They say if you take your money out, if you put in a SEP IRA or simple IRA or 401k or anything like that, it's a retirement account. If you take it out before 59 and a half, you get a 10% penalty. So you still can take it out. You'll pay taxes plus a penalty. Right. So that's the downside. And timing it might take a week to get you your money. So because we have to sell whatever's in there, stocks, bonds, gold, whatever's in there. We sell it, it goes to cash, and then we can send you the money. So it's not quite as quick as like a savings or checking account, but it's pretty quick. Okay. So yeah. And so what he was saying is on that protective focused portfolio, we're going to have majoritively these asset classes and very little of those. Okay, so in a nutshell. And then we have.
Again, so we utilize that protection focused strategy for those shorter term goals. We also utilize it when we have somebody who maybe doesn't want to take the risk investing more aggressively in the stock market. They want to make sure that they take on less risk and they have more potential for that investment to stay safe. The next strategy that we have is the growth strategy, which is for our longer term investments. That would be where if you're not planning to spend the money, for the next 7+ years, and you just want it to grow and you're willing to take on the extra risk of the stock market, allow that volatility to play out for hopefully bigger returns. Our growth focused strategy has primarily growth assets in it with fewer of the protective assets to make sure that we offset some of those losses when it does go up and down in the stock market. We have a third strategy as well, which is kind of our balanced strategy, which is just an even mix of the two. And so generally we use that for financial goals that are anywhere between 4 and 6 years from now.
Yeah, so kind of a way to think about if you're close to retirement, if anybody here is close to retirement, might be looking and saying, well, maybe I'm retiring in 4 years. Well, if you came and met with us, we would say, okay, depending on how much you're investing and what you've got going, we might put some of your money in the protection focused if you're going to spend in the next 1 to 3 years, some of the money in our balance strategy in the next 4 to 6 years, some of it in the growth focused strategy. So what we're doing is we're kind of divvying it up depending on, because if you're going to spend your money, no matter where we feel like the market is or the market's going, you're going to spend in the next 1 to 3 years, and the market can change really quick, right? Real estates and stocks and stuff. So since it can change so quick, we're just going to set that money in our protection focused strategy. And it's just a mix of those asset classes we talked about before, but it's just we have more of the protective asset classes, less of the growth, right? And we're just moving, we're making 3 different strategies with those different asset classes depending on what the goal is, right? What we're trying to accomplish. And one of the things that people hire us to do is also to try and kind of not predict where things are going, but to kind of reallocate their investments based on where we see the markets going. So we have different indicators and stuff that we'll look at to say, is the economy looking good? Is it looking bad? There's really only 3 directions that the real estate market or the stock market can go in. It can either be uptrending, which we were talking about, it's been that way since 2008, 2009 pretty much, right? It's been uptrending, had a couple bumps in the road, but it's been basically uptrending. In that time, which asset classes do we want? The growth ones, right? So we're going to position more there. And so we have the hard part is figuring out which trend we're in. That's the main thing. If we're in a trend that is going up, we want to be majoritively in stocks and real estate and things like that because that's what's going to get us the highest return in that environment. Those are also the things that are going to lose the most when the market changes. So what we do is, as the market looks like it's kind of high and starting to peak out, it'll go into a balanced position. And what that means is we call it like a sideways market, where it's when we were just talking about this, where it's kind of steady. Prices aren't really going up, prices aren't really going down, it's just kind of steady, right? So we call that kind of a sideways trend. So there's an uptrend, sideways trend, and a downtrend. So the sideways trend, we want to be in a balanced mix between our growth assets and our protective assets. And then when it goes to protection focused, that's when we see the trend changing, like in 2008, 2000, 2001, 2002. There's a lot of different parts of history where we were truly in a bear market. That's what they call it when it's going down. And so in those times, our goal is to have more of the protective assets and less of the other ones. So we're not trying to time it, but we're just trying to see, when does the trend change? When the trend changes from growth to balance, we're going to take some returns. We're going to take some of those profits. We're going to set them in more protective asset classes. We're going to buy more bonds and cash and gold and things like that. And then when it turns down, same thing. As it starts turning back up, we'll go more balanced, add a little more stocks to the portfolio. As it goes up more, we're going to add a little bit more stocks to the portfolio, because usually there's these long-term trends in the stock market or the real estate market, but there's also the short-term kind of volatility. So we're trying to eliminate the short-term volatility and really capture the long-term trends of where it's going. And then our job is try to position it accordingly. So try to make it to where it's making us money in the uptime and protecting us and trying to save us some money in the downtime. Make sense? Any questions on this? Yep.
I do have a question. So for the stocks this is for long-term investing, right?
Yes. Well, so this strategy, yes. If you had 1 to 3 years, the protection-focused strategy would be a short-term strategy. So 1 to 3 years. 4 to 6 years balanced. 7+ growth, which is what I just talked about, is more of an active movement between the three.
Okay.
Yeah.
Got it.
So if you had money, let's say you wanted to spend it or transition it to real estate or something like that in 3 years, I would say put it in the protection or the balance, depending on which one you're comfortable with. Most likely we'd recommend the protection focus. It can do better. Most likely going to do better than the cash in your bank. We can't guarantee. That's like our disclaimer. The SEC makes us say, right, no guarantee of returns, but most likely you're going to do better because you're investing in bonds that are giving an interest rate of 3 or 4%. So that automatically is higher than your bank's going to give you. So we're just kind of giving you enough return to satisfy that time period, but we're trying to protect if the market does tank in a 6-month period of time, you're not leaving that money highly susceptible to a big downturn or something.
Can you go to the next slide?
Yep.
So whenever you go the growth focus.
Yeah. And that would be for long-term money, by the way. Yeah.
That's for long-term. But this 3 areas here, so if the market goes down, just out of curiosity, why would you want to take your money out of that one and then go reinvest it into the bonds and stuff like that? Why wouldn't you just ride the wave, wait for it to come back up, and when you go higher?
Yeah, great. So great point. So Garrett and I were talking about this before. Logically, we know if you're investing for the long term, you hear people say, put it in the stock market, leave it, right? Or put it in the real estate market, just leave it. Don't look at the price, don't look at whatever. I think that's good advice. The problem is we're human beings and we have emotions, and most people don't do that, right? Most people don't do that. And that's why this chart exists, is because most people don't do that. If everybody did that and just let it ride, this actually wouldn't happen. Because what causes this? People selling. Pulling out money. Well, if people didn't pull out money and sell, this wouldn't happen, right? So it's kind of counterintuitive. So if everybody listened to that advice and said, you're for the long haul, just leave it in. Well, as our experience as advisors with clients, hundreds of different clients, that's just not, most people get fearful. They hear the news, they hear the whatever, they're fearful of it. So because of that, our strategy is to say, well, let's try to be more protective in this time, and then in the growth times, let's try to be more aggressive. Because if you're down 10% when the stock market's down 40, you're feeling pretty good, you're more likely to stick to the strategy. If you're down 40% or more, you're very likely, or most people are very likely to say, it's going to keep going down, I'm going to cut my losses and just call it a day, right? So that's why it's to manage emotions, really. So long-term investing could be good, but it's really about emotions. Yeah.
What type of penalty is there to withdraw your money from the short term?
So yeah, if it's in a like Matt was saying, if it's not a retirement account, there's no penalty. So if there's not a retirement account, no penalty to sell or whatever. We'll talk about the cost too. We charge like an asset-based fee. So kind of like you guys get paid, you sell a house, you get paid on the price of the house. We get paid on the price or the amount of assets. It's a lot smaller percentage, but it's the amount of assets. But it's an ongoing because we're doing the management behind the scenes. So we're doing all the active management. So that's how we get paid, but there's no transaction cost. There's also no cost to purchase in, and there's no cost to sell. So if you like, hey, I want my money, I'm going to take it. You sell, you go. It's kind of a pay-as-you-go system. So once you take the money out, you're not paying for that money being managed, because what you're really paying us for is to manage the money on your behalf, to move it between those different asset classes as we see fit. So yeah, so if you have a short-term need, you're like, oh, I want to put it in for 3 years or something and then take it back out when the market crashes in real estate or something, then there's no surrender charge to sell it.
So if
cool.
I mean, if it's in us, a deal hits very quickly. Like we see something, we have to act quick.
Yeah.
On those short or those non-tax or non-retirement funds, how quickly? I mean, we could just. I guess we could put an offer, show our balance statement as that. We could get that out within 10, 14 days for an
within a week, probably. Yeah.
Within a week. Okay. Just
yep.
curious.
Yeah, and we've done a lot of that where we'll actually wire it straight to the escrow.
Okay.
So we just free up the cash. They send us the wire instructions. We wire it straight to the escrow. Yep.
Yeah,
so it's really easy.
About 2 days because we have to sell the assets in the portfolio. It takes about 2 days for that to clear. As soon as that clears, the cash is ready, and we can, like you said, we can wire it straight.
Oh, very cool.
Yeah.
Yep. So that's really easy to do. And like I said, these seem complicated. They're really easy to set up, especially the SEP or the individual account. It's like one Adobe Sign packet. We have you sign. You guys do like e-sign or something, probably for real estate. But it's like one packet. You sign it, put in the money. We handle the rest. So it's less complicated than most people think. And it's just if you believe in the strategy and you're like, okay, I can work with these guys, then it works. Yep.
So you were saying that you guys will write out the time to check, do the wire transfer to the bank if you're buying a property.
Yeah.
If you have an investment account or retirement account and you buy properties like investment properties, can you do that and not be penalized? And just like borrow the money against your retirement account and then pay it back.
It's kind of. So we don't do that. There are companies that'll do a self-directed IRA, which is what you're talking about, where you're actually buying real estate within your IRA. It's very complicated. You have to have like a third-party kind of person in between to like make sure all the numbers add up. Because anytime you spend money for that property, fix a roof or something, that's money that's in your IRA, right? And so it becomes very complicated from an accounting standpoint. So there is an option to do that. We don't do that. For people, the way we invest in real estate in like a portfolio would be through REITs, real estate investment trusts. So they're traded portfolios of real estate. So you might get a 4 or 5% dividend from those, and then you get whatever the kind of market price of up and down change. You get that as well. So that'll track like we have I think 15 to 17 different real estate investment trusts that we'll invest in, and they're traded just like a stock. So you can buy and sell them quickly, but when you buy them, you're holding this big portfolio of real estate. So you're getting exposure to the real estate market without having the renters or the headache or the fix-up. So if you wanted to do real estate within like a SEP IRA or a simple for tax purposes, I'd probably recommend that. The other thing too to think about is you get a lot of tax deductions on real estate, right? So to put it inside an IRA, it's kind of defeating the purpose, right? It's like keep it outside the IRA, because if I buy stocks outside the IRA, I don't get that many tax benefits. If I buy real estate outside, I get the depreciation and the write-offs and stuff. So I'd say buy the real estate outside of it, and then inside of it, do stocks and bonds and other stuff that you're going to get taxed more on. So, cool? Any questions so far? Did we lose you? Following you? Yeah? Guys, got it? Cool. Guys and gals? Okay, so let's see what we talked about. Okay, so this part's kind of cool. So one of our kind of niche things is that we're a private Christian company. We don't require our clients to believe the same thing we believe, but this is what we believe. So when we pick our stocks, we do 2 screens. So the very first screen we do is actually a moral screen. And there's a pamphlet, this one right here, this orange one, that you guys all have. It kind of explains the process, how we go about doing that. There's been actually some research that shows when you do this kind of a screen, you actually end up with better companies, because they don't get involved in scandals and they're not doing bad stuff with their supply chain and all this stuff. So you can read more about how we do it, but basically the first screen we do is a moral screen. So we just go through and say, what are the companies that we think are operating with highest integrity, and they're not doing things that would violate anything that we don't believe in. So we do that screen first. After we do that screen, then we're going to do the financial screens, which are like, how much debt does the company have? What's their price earnings ratio? What's their growth estimates? What's their cash flow and balance sheet look like? So we're going to look at all those things as well, because we don't want to, even if they pass the moral screen, doesn't make them a good company to invest in. They could be, heavily leveraged. They have too much debt. Their earnings aren't growing. So on that company, we don't want to invest in them. So we're going to use these two screens where we're picking that stock. So if we have the growth focused strategy, we might have 70 to 80% stocks. So we're going to use these screens to figure out which stocks we're going to put in that basket. If we're in the protection focused strategy, it only has about 30% stocks, but we're still going to use this kind of methodology to figure out which stocks we're actually going to invest in. Okay. And the good part about it too is you actually don't end up with a lot of the bigger companies like the Apples and the Googles and stuff, which you hear about in the news and all that, but those companies are so large that they have to make so much money in order to have a substantial increase in their stock price. With our strategy, you end up with more small cap and mid-sized company stocks, which have a lot more room to grow. So it's kind of like if you bought $1 million house, it's as a rental property, it's going to be harder to find a renter. It's going to be, that property's got to go up quite a bit. You buy a bunch of $200,000 houses, you're probably going to do better off, over time. It's kind of that idea. So smaller companies, mid-sized companies in the stock market have a higher long-term return. They can be a little more volatile, but they have a higher long-term return. The bigger companies kind of move and chug along a little bit more, kind of stable, don't have as high of returns usually. So any questions on this? And we can talk more about the booklet as well. If you guys want to come up afterwards, if you want to make a call or appointment, we'd love to talk about that. Cool? Okay. And then we kind of touched on this a little bit.
So once we go through all the other steps and we've actually decided, what it is that you want to invest in, we've developed the portfolio and got you working toward those financial goals. What we also do is we maintain all the portfolio management, like Jake said. If depending on kind of what level of advice you want from us, we can meet with you annually, semi-annually, quarterly, however often is necessary for your situation. We do all of the rebalancing of the portfolios to put them back into their ideal
weightings.
Yeah. And, so if you're in a portfolio that has 40% large cap stocks, if the large cap does well and all of a sudden the value up there is into the 50s, we'll rebalance that portfolio to put it back into 40%, make sure that everything is where it's supposed to be. And pretty much.
Yeah. So in a nutshell, this slide just to tell you we do it for you.
Yeah.
So you set up the SEP, sign the paper, add the money, we do the rest, and then we'll meet a couple times a year to just say, here's where it's at. Has anything changed with your situation? What are your goals? What are you trying to do?
But also, if I do set up a SEP and I just want you guys to take money from my account monthly, and I don't have to think about it. Do you do that, or do I have to write a check? How does that work?
No problem. Yeah, we can set up a bank account link, and just you can tell us how much, and you'll pull it as long as it's within the IRS limits.
Up it, down it, whatever.
Up it, down it, whatever you want.
Cool.
Yep, really easy.
Well, in addition to this as well, a lot of times, we know that you guys deal with clients who may be moving into retirement. They're downsizing from a house to another. They may end up with like a large sum of money afterwards that they're asking you about. What do I do with this? How do I invest it? Do I let it sit at the bank, or what do I do? And depending on that situation, or depending on your situation, if you're getting closer to retirement, we also offer more comprehensive financial planning services that help you do like insurance coverages, make sure that you and your family are covered properly. Estate planning, we work with estate planning attorneys to help you set that up if that's necessary for you as well. So that's also an addition that can be beneficial to you as well as your clients.
Yeah, and especially if you're getting closer to retirement, we have some cool calculators and stuff that'll kind of project out your cash flow in retirement. So you might have a couple rental properties, you might have some money in retirement accounts, you might have some money in just other stocks and bonds and places like that. So if you have, kind of this mixture of things, some Social Security, maybe you had a little pension, whatever it is, there's a lot of pieces to the puzzle. We'll kind of let you know, okay, here's how much we think you can spend in that first year based on all your income sources, based on inflation, so that you don't run out of money. So we'll kind of help people figure that out. So if you're close to that retirement spot, we can help you with that. So, cool. That's the end of our presentation. We made it before 11. Anybody have any questions, any follow-up questions or anything? Want to go back and see any of the slides? Did it make sense? Was it helpful?
So if you put money into the account, all right?
Yep.
And then you want to pull it out, do you get taxed on it after 3 years?
It depends on what it is. So if it's a SEP IRA, is that what you're talking about? Yeah, the SEP IRA, you have to be over 59 and a half before you pull it out if you don't want a penalty.
So but if you put in there, you don't have to pay the taxes?
Correct. Yeah, until you pull it out. So whenever you pull it out at age 60 or whatever, that's when you'll pay the taxes. Yep, on whatever the amount you pull.
What about, so, I mean, typically, I probably do this wrong, but I put 25, 30% into an account for taxes as the year go. And I always have an account that builds up money at the end of the year.
Yep.
And then I always try to put extra, and I'm like, ooh, I got a tax return. Is there a better strategy to put that into something else that makes a little bit of money, but it's only a short term? I'm talking like.
Yeah, for that, I would say a CD or savings
Just
account.
something like that.
Yeah,
Okay.
yeah, because that's so, like, you know you're spending it, it's usually less than a year or whatever.
Yeah.
The protection focus would probably be fine. It's had like 3 down years in like the last 40 years. It had 3 down years, the protection focus strategy, so we were able to back test it. In 2008, it was only down like 5%. So I mean, even the market tanks, that's the protected place, but there is a small chance it's down a little bit when you need it. You're down 3 or 4, 5% when you would have been up 1% in the savings account. So I mean, if you really want to roll the dice, you could use the protection focus, but you're not going to make that much either way. And that's why I tell people, are you moving the needle much?
Yeah.
Yeah, you're risking. Yeah, if it's 50 grand or whatever, you're risking a couple $1,000. Yeah, to make a couple $1,000. So, yep. Good question. Does this make sense? Was it helpful? Did you learn something you didn't know before?
How do we do how do we sign up with you guys for the SEP IRA? I mean, many of us are going to have taxes due in
It's
a couple
coming.
months. So how do we do that?
Yeah, so our cards, our numbers on the back of this, or the back page of this, we got cards in the back. And if you wrote your name on the little thing as well, we'll be sending you some emails and stuff on the thing, so you can contact us. And it's a free consultation, so you just come into the office, we'll sit down, we'll talk to you guys about your situation, figure out what makes sense. And if you're like, yeah, one of these things makes sense, and also for your clients, if somebody's selling a house, they've got a big proceeds, and you're like, hey, I can recommend these guys to help you figure out what to do. We'll walk them through the exact same thing. So you already know what we'll talk to them about. We're going to tell them, depending on when you're planning on spending the money, that's how we're going to invest it, and then we'll actively manage it between then. So if somebody sold a property, they've got a couple $100,000, they need to park it somewhere for a short period of time, or maybe even a long period of time. Maybe they're just going to rent, or they, whatever. Then if that's the case, we can help them invest it for that period of time as well. So they don't have to use the SEP or simple, like Matt said, it's just called a non-qualified account. Any money that you have, you can put in there just like your checking or savings. You can put money in there and invest it. So, cool?
Thank you.
Okay, yeah, no problem. Yeah. All right. Now go sell real estate. Yeah!
Thanks, guys.
Yeah, no problem. We'll take a couple of these back because these ones aren't used. Yeah, we'll have some extras. Annuity, yeah. Okay.
If I give you a chunk, like $10,
Yeah.
do you have a limit? How much I can?
No, yeah, 10,000 work. So we just talked to you like we said. We'll say, when do you want to spend it? What's your plan for it? How
Just to try.
Yeah, how aggressive?
I had the money.
Yeah. Fidelity, okay, yeah. Yeah, if you want to give us a chunk and just say, let's see how it works, and you can compare them.
Yeah.
We'd love to do that.
Then I transfer the money to Massachusetts, but I only get 1%.
Oh.
1% of $100, 1 cent.
Okay.
$100.
Right. Okay. Yeah. Right.
Yeah. So would you do better?
Yeah. Yeah, because that sounds like it's just, is it like a CD or something, or?
It's annuity.
An annuity, yeah. Okay. Yeah, no, it's probably, is it called a fixed annuity? Does that sound?
No. It's kind of, I can get the money because I'm over 60.
Yeah, right.
So
yeah, no, I would.
60 then.
And if you want to schedule. right, if you schedule an appointment and you want to bring us the statement, we'll take a look at it and say, well, you know, this is what it is and this is how we can, you know, help it and all that. Yeah.